Hey traders, today I want to walk you through a strategy called a bear call spread, and it's on Alibaba. But before I get into the details of the spread, I want to kind of just walk you through the process of how I found this idea. So firstly, I have a watch list of stocks that are good for trading options, and I've sorted that in Interactive Brokers by the IV percentile, 52-week IV percentile. And I noticed that Alibaba had pretty high volatility, so it's in the 89th percentile. Then next thing I did was take a look at the volatility chart. So I'll just show you that on ivolatility.com. And you can kind of confirm there that on that yellow line, it's up at the top end of the range, up around 46%, pretty much as high as we've seen. We have got over 50 a couple of times, but really, really high IV for Alibaba compared to the last 12 months. And then if we go and look at the chart, we can see why it's had a bit of a rough patch here. It's had a big gap down here on the news coming out of China, and technically it looks quite bearish. So that's why I decided on a bear call spread. We've got a bearish down day today, bearish candle. We're below a declining 20 and a declining 50-day moving average, and we're below the 200-day moving average. So decided to go with a bear call spread. We've looked in the past at a couple of examples of bull put spreads. So this is basically the opposite. So if we go back to Risk Navigator, I've gone with about a 22 delta on the 260 call. So we're selling one of those and buying one of the 270s. Now, we're in a bit of a tricky spot here with the February expirations, about 43 days away. January expiration's only about 8 days away. So we're kind of in that middle period where, maybe February's a bit too long, January's a little bit too short. But I've gone with February. You could try and find one of the weekly options, maybe towards the end of Jan or early Feb, that might be a better fit. But looking at about a 20 delta, if you look here, we're generating about $140 in premium with about 860 at risk. So that's a pretty good return on capital if it's a successful trade. And in terms of a stop loss, I wouldn't want to lose more than about $200 odd on this trade. So if we look at the $200 axis and on a T plus zero, that comes out in about 252, 253. So I'd probably set a stop loss at about 250 here. If Alibaba rallies up to 250, I'd admit I'm wrong on the trade and I'd get out before the losses got too bad. If that happens really quickly, I'm going to be near that $200 loss. But if we change that T plus zero line, let's say that happens in 2 weeks time. If it breaks 250, well, we're still down about 150. So that's a pretty good point for me for a stop loss. Otherwise, I'm going to hold to expiration. Other than maybe in terms of taking profits, if Alibaba has a big drop and I've achieved 50% of the premium in less than 50% of the days to expiration, I might take profits early, free up the capital and look for new opportunities. So that's a bear call spread on Alibaba. Not a trade recommendation, of course, but just wanted to walk you through a little bit of the process of how I found this idea and how I would go about setting it up. So hope you enjoyed the video, and I'll talk to you soon.